So let's get further into Chapter 11. Scenario and other what-if analysis. This is section 11.2. So here's an example where instead of saying, oh, we forecast sales of 100 units, instead maybe we say we think it could be 100, but it could be 10 units on either side. So maybe it'd be 90 units, or maybe it would be 110 units. Then they go into a broader example. We have a project under consideration that costs $200,000, a 5-year life, no salvage value. Depreciation is straight line to zero. Well, a 5-year life at $200,000, that would be $40,000 per year. The required rate of return is 12%, and the tax rate's 21%. And here are values that they provide for us. So we have a base case of unit sales of 6,000 and price per unit of 80, variable cost per unit of 60, and fixed cost per unit per year of $50,000. And then they give a column that's lower bounds and upper bounds, and those are not best and worst cases. Let's go through them. I've identified with W's the worst and with B's the best. So on unit sales, if our base case is 6,000 and our lower bound is 5,500 and our upper bound is 6,500, well, 5,500 would be the worst case and 6,500 would be the best case. For price per unit, same thing. The lower bound is the worst case. The upper bound, 85 versus 75. 85 would be the best case. But when we get to costs, we like lower numbers, not higher numbers. So our variable cost per unit, the lower bound is 58. Well, that's the best case. We would like variable cost to be low. And 62 is the worst case because we don't want variable cost to be high. Likewise, we want fixed costs to be low also. So the lower bound of 45,000 is our best case scenario, situation, let's say, and 55,000 would be our worst case. So the common confusion among students is to think of this lower bound as being the worst case and upper bound as being the best, and it's not like that. It crosses over. So I've marked up these pages, and let's take a look at this case in more detail, and I'll just show you the one that I've gone ahead and put together. We've got a base case with 6,000 units, and the price is 80 per unit. That's 480,000. Variable costs at 60 per unit times 6,000. That's 360,000. Fixed cost of 50, depreciation of 40. That gives us an EBIT of 30,000. Taxes at 21%, 6,300. That gives us a net income of 23,700. Add depreciation to get cash flow of 63,700. And that's really what we have up here, except without showing the depreciation part. Now in our scenario analysis, what we're going to do is look at the best and worst case scenarios. And as I mentioned before, sometimes the best case is going to be an upper bound value, and sometimes it's going to be a lower bound value. So we're going to put the best together and the worst together. So our best case in unit sales would be 6,500. Our best case in price per unit would be 85. Those are the two high numbers. The best case for variable cost would be a low number, and the best case for fixed cost would be a low number. And of course, it's just reversed in the worst case scenario. So if we insert those numbers, we would get, for the worst case, 5,500 in units, 75 in price. This would be our sales. Our variable costs, I haven't shown that. Would be 5,500 times the variable cost per unit, and the worst case variable cost per unit would be 75. No, that's not right. It would be 62. So that's 5,500 times 62 would be 341,000. and then we have our highest fixed costs and our depreciation, so we end up with EBIT here, and taxes. And now this is a case that does cause some grief. If you have a negative earnings before interest and taxes, then instead of subtracting taxes, you would add taxes. The idea there is that if you have a loss, well, that loss is going to be applied to the whole company, and so it will reduce the whole company's EBIT by $23,500, and therefore will reduce the company's taxes by 21% of that. So our taxes here are actually a positive number instead of a negative number. So $4,935, we end up with a net income of $18,565 and a cash flow of $21,435. And for the best case, you can see it here, same sort of idea. Note that we have each of these 4 variables, and you'll see that this $21,435, which is the worst case scenario cash flow, is this number right here, and the $111,495 is this number right here. And they calculated NPVs, which you can do, and you see that we run from an IRR of normal base case 17.8% and worst case minus 17.7%, and best case 47.9%. So base, worst, best. Now we go over to sensitivity analysis. And sensitivity analysis is the same sort of thing, except we're only going to change one variable at a time to see how sensitive our net income, our net present value, is going to be relative to the change in one of our variables. And so in this case, they say, well, let's just make it the unit sales. So what would happen if we kept everything else the same, but we just vary unit sales? So this is what it would look like. Here's our base case for unit sales, our worst case, and our best case. And here's our price, the same variable cost per unit, which doesn't give you the same variable cost because there's a different number of units, but you can see it's $60. 5,500 times $60 is this, and 6,500 times $60 is this. Fixed costs are the same, so all we're varying is units. Variable cost, price, and fixed cost all stay the same. And our base case gives us the same cash flow as we had before, $63,700. Our worst case, $55,800, and our best case, $71,600. And so what it shows here is that in each one of the cases we actually have a positive NPV. So even if our unit sales is at the worst projection, it still gives us a positive NPV. And at the best case, it's more positive. So that would make us more comfortable with our estimates of our units of sales. Over here, what it does is say, well, what if instead we kept everything the same except for fixed costs? And if we allowed fixed costs to be either $50,000 in our base, or $55,000 in our worst, or $45,000 in our best, then what would happen to cash flow and NPV? And you see what would happen. And in each one of the cases, it still ends up being a positive NPV. So what that's telling us is if our estimates are off a little bit on fixed costs, it's not a killer. We can still have a positive NPV. And the same thing with unit sales. And they don't show you what would happen with the others, but you could calculate those if you wanted. I'm going to have another video that's just on simulation analysis.